Hi everyone, and welcome to the exciting world of the stock market. Investing might seem intimidating at first, but I promise it's easier than you think. In this guide, we'll break down the basics of investing in stocks. We'll use simple terms everyone can understand. Whether you're just starting out or need a refresher, this guide is for you. Let's get started on your journey to financial success. Imagine you own a piece of your favorite candy store. You love the candy, the atmosphere, and the friendly staff. Now, imagine that you could actually own a part of that store. Not just be a customer, but have a real stake in its success. This is essentially what owning a stock means. When you buy a stock, you are purchasing a small piece of a company, just like owning a slice of that candy store. That's what a stock is, a small piece of ownership in a company. Think of it as owning a slice of a pie. Each slice represents a portion of the whole pie, and in this case, the pie is the company. The more slices you own, the larger your share of the company. Stocks are often represented by certificates, which are like proof of your ownership. When you buy stock, you become a shareholder, which means you own a tiny part of that company. As a shareholder, you have certain rights and privileges. For example, you may have the right to vote on important company decisions, such as electing the board of directors or approving major corporate actions. You also have the right to receive a portion of the company's profits, which are often distributed as dividends. Companies sell stocks to raise money. This process is known as issuing stock. By selling shares to the public, companies can raise significant amounts of capital without having to take on debt. This money can then be used for various purposes, such as funding new projects, expanding operations, or paying off existing debts. The stock market is where these transactions take place, and it plays a crucial role in the global economy. They use this money to grow their business, develop new products, or expand into new markets. For example, a tech company might use the funds raised from selling stock to invest in research and development, creating innovative new products that can drive future growth. A retail company might use the money to open new stores in different locations, reaching more customers and increasing sales. The possibilities are endless, and the goal is always to create value for shareholders. As a shareholder, you can potentially benefit from the company's success. If the company performs well and its stock price goes up, the value of your shares increases. You can sell your shares at a higher price than you paid for them, making a profit. Additionally, if the company pays dividends, you receive a portion of the profits. However, it's important to remember that investing in stocks also comes with risks. The value of your shares can go down if the company performs poorly, but with careful research and a long-term perspective, investing in stocks can be a rewarding way to build wealth. Think of the stock market like a giant online marketplace. Just like any marketplace, it's a place where buyers and sellers come together to exchange goods. In this case, stocks. Stocks represent ownership in a company, and owning a stock means you own a small piece of that company. This marketplace operates both physically, in places like the New York Stock Exchange, and virtually, through online trading platforms. It's where buyers and sellers come together to trade stocks. Buyers are looking to purchase stocks they believe will increase in value over time, while sellers are looking to offload stocks they think might decrease in value. This constant interaction between buyers and sellers is what drives the stock market. Buyers want to purchase stocks they believe will increase in value. They do this based on various factors such as a company's performance, industry trends, and economic indicators. When a company is doing well, its stock price tends to go up because more people want to buy into its success. Sellers want to sell stocks they think might decrease in value. This could be due to poor company performance, negative news, or broader economic downturns. When more people want to sell a stock than buy it, the price of the stock tends to go down. The price of a stock goes up when more people want to buy it than sell it. This is because the demand for the stock is higher than the supply. When demand exceeds supply, prices rise. This is a fundamental principle of economics that applies to the stock market as well. Conversely, the price goes down when more people want to sell it than buy it. In this case, the supply of the stock is higher than the demand. When supply exceeds demand, prices fall. This dynamic creates the constant fluctuations in stock prices that we see every day. It's all about supply and demand. Understanding this basic concept is crucial for anyone looking to invest in the stock market. By keeping an eye on supply and demand, investors can make more informed decisions about when to buy and sell stocks. This knowledge can help them navigate the complexities of the stock market and potentially achieve better returns on their investments. Stock prices are constantly changing. It's like a roller coaster ride. The ups and downs can be thrilling, but they can also be nerve-wracking for investors. Understanding why these changes occur can help you make more informed decisions. Several factors can cause these fluctuations. The stock market is influenced by a complex interplay of various elements, each contributing to the rise and fall of stock prices. One major factor is a company's performance. When a company performs well, it often sees an increase in its stock price. This performance is usually measured by earnings reports, which are released quarterly. These reports provide insights into the company's profitability, revenue, and future outlook. If a company reports strong earnings and positive growth, its stock price is likely to go up. Investors are more willing to buy shares, driving up demand and consequently, the price. Positive news about a company, such as the launch of a new product or expansion into new markets, can also boost its stock price. On the other hand, negative news, economic downturns, or even global events can cause stock prices to fall. For instance, if a company reports lower than expected earnings, its stock price might drop as investors lose confidence. Economic indicators such as unemployment rates, inflation, and GDP growth also play a significant role in stock price movements. It's essential to remember that investing in stocks always involves some level of risk. Market volatility means that prices can change rapidly, sometimes without any clear reason. External factors like political instability, natural disasters, and changes in government policies can also impact stock prices. Therefore, it's crucial to stay informed and be prepared for the inherent risks of stock market investing. Diversifying your investment portfolio can help mitigate some of these risks. By spreading your investments across different sectors and asset classes, you can reduce the impact of a poor-performing stock on your overall portfolio. Long-term investment strategies often prove more resilient to short-term market fluctuations, providing a more stable path to financial growth. Educating yourself about the stock market and staying updated with financial news can also empower you to make better investment decisions. Many resources are available, from online courses to financial news outlets, that can help you understand market trends and develop a sound investment strategy. Remember, knowledge is power when it comes to navigating the stock market. To start buying and selling stocks, you'll need a brokerage account. Think of it like your gateway to the stock market. A brokerage account is an online platform that allows you to buy and sell stocks easily. Many brokerage firms offer different account options and fees, so it's essential to do your research and choose one that's right for you. Once you've opened an account and deposited funds, you're ready to start investing. One of the most important concepts in investing is diversification. Don't put all your money into just one stock. Imagine investing all your savings in a single company, and that company suddenly faces unexpected challenges. You could lose a significant portion of your investment. Diversification means spreading your investments across different companies, industries, and asset classes. This approach helps to reduce risk. If one investment doesn't perform well, others may compensate for the losses. Investing in the stock market can feel overwhelming, but don't worry, here are some practical tips for beginners. First, start small. You don't need a lot of money to begin investing. Even a small amount invested regularly can grow over time. Second, do your research. Before investing in any stock, take the time to learn about the company, its financials, and its growth prospects. Knowledge is power. Investing in the stock market is a marathon, not a sprint. It's essential to have a long-term perspective. The stock market will always have its ups and downs, but over the long term, it has historically trended upwards. Avoid making rash decisions based on short-term market fluctuations. Stay focused on your investment goals and ride out the volatility. Patience is key. Congratulations, you've taken the first step towards understanding the stock market. Remember, investing is a journey, and it's never too early or too late to start. By following the tips in this guide, you can approach investing with confidence and work towards achieving your financial goals. Start small, diversify your investments, and remember to think long-term. Happy investing.